All across America, people are needlessly overpaying the interest on their mortgages and other debts without even knowing it. In this video, we will show you how thousands of people are saving interest and paying down debt faster than they ever thought possible. We would now like to review 4 of these key money-saving principles. The first money-saving principle is strategic payoff. The second is interest accumulation. The third key principle is interest float. And the fourth is interest cancellation. Here's what an amortization schedule looks like on a 30-year, $200,000 loan at 4.5% with a payment of $1,013. If this client makes their payments as scheduled, by year 20, we can see they have barely gained half of their equity. Yet they have already paid over $243,000 in mortgage payments. And at the end of 30 years, they will have paid over $364,000 for their $200,000 loan. That's over $164,000 in interest payments. In other words, they will have paid over 82% of the original amount they borrowed just in interest payments. Banks hold depositors' money as long as they can to leverage themselves. That is, making money off of your money. They wait until the last possible minute before dispersing funds to various accounts, so they can, in the long run, hold on to every cent. This is how they continue to make a significant profit. Now it's your turn to have a proven system that runs the strategies and calculations for you. Did you know that if you pay your mortgage on the 1st, when the bank asks for your payment, the bank can hold on to that money, gaining interest on it daily for up to 14 days, and apply that payment on the 15th? What if you let that same money work for you those 14 days? It's called time value of money. Our system has many thousands of math algorithms working for you. That means that your system is tailor-fitted to your specific financial situation, using your existing checking or savings account. Let's discuss the first of the 4 money-saving principles: strategic payoff. Think about this. In what order would you pay one debt? Well, there's really only one way to pay it. What if you had 2 debts? You had a Visa card over here. Which one would you pay off first? Well, you could pay the mortgage and then the Visa card, or you could pay the Visa card and then the mortgage. So there are 2 possible orders to paying those debts off. What if you had 3 debts? 3 debts, there'd be 6 different ways to pay that off. If you had 4 debts, there'd be 24 different ways to pay that off. 5 debts? With 5 debts, you would actually have 120 different possible ways each month to get to the fastest way to zero. And only one of them, one of the 120, is the correct and fastest way. The system recalculates each time you have a change in the amount owed, interest rates, the ratio of principal applied versus interest paid, and many other determining factors. Bob and Katie make $5,400 per month net, or after taxes, and they spend a combined of $5,200 per month on all of their debts, expenses, and entertainment. This means Bob and Katie only have $200 left over at the end of the month. Do you need $200 to make the system work? No. You just need to spend less than you make. And we can show you as little as $1 left over will work. Here are their debts. Bob and Katie have direct deposit with the companies they work for, so their paychecks go directly into their checking account. The system prompts them to transfer that $5,400 from checking into savings. So for the sake of demonstration purposes, realizing that everyone's situation is different, we're going to say that Bob and Katie can pay most of their bills on their credit card or line of credit. We realize that the online system will be customized for you, and that your financial situation will be different from Bob and Katie's. A credit card or line of credit is not required for the system to work. We're just keeping this simple so that you can understand the general gist of how the system works. So, they pay for their food, gas, and all of their household expenses, including all the bills shown here. Because their living expenses are $5,200, this means that they now owe $5,200 on their credit card or line of credit. The system now takes that debt into consideration and will address it the following month. You will notice that the debt amounts have changed because they continue to make their regular minimum payments as scheduled. So, in month 2, Bob and Katie's savings account earned interest. Now they have $5,413 in their savings account. This is the second money-saving principle: interest accumulation. The term reducer system prompts them to take $3,884 from savings and transfer it into their checking account. After that, it prompts them to take $5,200 and pay that credit card down to zero. We used someone else's money for 30 days and paid them no interest, and allowed our money to work for us at the same time. This is the third money-saving principle: interest float. It then prompts them to take $4,084 from their checking account and pay towards their primary mortgage, and identifying an additional strategic transfer. The system calculates an exact amount of $798 and prompts them to transfer this amount out of the savings onto the Visa. So this is what the beginning of month 3 looks like. We now owe less on the mortgage and less on the Visa. And this is what happened to the mortgage. Their new balance is $195,652. Their interest rate and minimum monthly payment stayed the same. But they canceled 15 months worth of mortgage payments and saved $11,162 in interest. This is the fourth money-saving principle: interest cancellation. What does this mean to you? If these were your numbers, you could now pay yourself what you have been paying the bank, because you would no longer have to pay those additional 15 months at the end of the mortgage. You can see how powerful this is. Can you do this on your own? Perhaps, with many hours of strategizing, overanalyzing, calculating, and constantly updating. And providing you're a math genius. So let's recap. Here are Bob and Katie Smith. They are 40 years old. On the conventional side, they will be paying on their debt until they are 70 years old. That is 5 years after retirement, if in fact they can retire at that point. With this time-saving system, they will be debt-free at 52 years old. That's 13 years prior to retirement, and they can pay themselves instead of their creditors. Plus, they saved over $101,000 in interest on their mortgage and over $38,000 in interest on their other debts. It is important to understand the financial implications of holding on to debt. Holding on to debt may indeed cost you more money than you can earn on your own. As a society, we are emotionally involved in thinking that making more money is our answer. Yet, it is our debt that in reality holds us back from achieving our ultimate financial goals. Sometimes people say, "I could try and do this on my own." So let's look at what would happen if Bob and Katie sent their $200 discretionary income each month to their mortgage. First of all, that is not what the system does. It does not require you to increase your minimum monthly payments. Second, we know that most people will only do this for a short period of time because, well, life happens. However, if they did send in the money, they would not have access to those funds and would only eliminate around $52,000 in interest. Bob and Katie are not even addressing their other debts. You might be doing something to eliminate your debt, or you may be doing nothing. Either way, we have something here that will help you get you out of debt faster than any traditional method, book, CD, DVD, or class will ever teach you. No more calculating your debt, interest rates, payments, and guessing which combination will save you the most money and time. Because the system is personalized with your information, so you have a clear, easy-to-use plan that is in line with your goal of getting the fastest way to zero.